We actually think there are signs all around the world that deflation will be the bigger problem. I kind of like that. If everybody is sure something's happening and you have evidence brewing that that might not be true, those are great calls. Now, I have a macro background. If I were running a macro fund, I think it would have done pretty well this year, but that's not what we do. We do have a point of view, though, on deflation from two angles. Cyclical, in the pipeline, commodity deflation is proliferating. And then downstream at the consumer end, and this is globally, we are being overwhelmed by inventories. So we believe in this holiday season that will become clear. It was interesting to see the online expectations for this holiday season, only 2.5%. That doesn't allow much room for real growth or inflation, right? Something's wrong out there, number one. And then the other thing is innovation, especially the amount of innovation that is evolving today, is inherently deflationary. There are massive deflationary undercurrents. And the base of these new ways of doing things is getting high enough to start moving the needle. So I believe in the next 3 to 6 months, you're going to hear more talk about deflation. We were struck at the unanimity of the vote among the Fed governors. And that tells us that this discussion is not getting out there broadly enough. And so we wanted to raise some points, specifically the commodities I just mentioned, downstream, used car prices. Used car prices were one of the first indications that the supply-demand imbalance was going to become extreme. They went up 54% year over year, tested 45%. Now they're down year over year. And we think they're actually going to go down a lot more. Why? Because of the shift, consumer preference shift to electric vehicles. The residual values of gas-powered vehicles, we believe, is going to fall apart. Many people inventoried a car because they did not want to take mass transit. They didn't need that car. Mass transit is back. Now they were looking at prices saying, oh my gosh, I could get a nice profit. Now they'll have an inventory loss. Maybe they won't take it, maybe they'll keep the car. But we think the dealers are going to be in a lot of trouble. They already are. The stock market is telling us. I'll also make a point that what we have in the Fed is really a Keynesian Fed that does believe that inflation and demand are positively correlated. The history in the 80s, 90s, and the 2000s is that is not true. When growth picks up, productivity picks up, right? And that is a potent anti-inflationary force. The other thing that's going on, and it's been interesting to watch the surprise around the dollar's increase, 25% in the last year. That's another powerful anti-inflationary force. You know what the problem in the emerging markets? It's crushing them. Why? I remember, I've been in the business for a while, as most of you know. In the early 80s, the dollar did the same thing in response to monetary policy. And we ended up in the Plaza Accord and the Louvre Accord, where all of the treasury ministers around the world, including our own, decided to sell dollars and buy those other currencies because that dollar increase was becoming deflationary. Why? Dollar-denominated debt, right? As their currencies are falling apart, their ability to service dollar-denominated debt is disappearing. And that's why many of them are going to the IMF. You've got the IMF, the World Bank, and one other organization basically saying, do you understand what's going on out here? The US doesn't. It really doesn't. We are somewhat myopic, and we are the strongest economy in the world, but it's going to come back to bite us if we're not careful. I do think what is happening now, we saw a dry run of it before COVID. So if you remember before COVID, as we realized what a problem we had on our hands, the globe had. I think the markets were down in 1 month's time, 25%. We were down 46%. From those lows, as you just said, we from April 20 to 21, 350, 360%. Since then, just to keep the keep the perspective here, down 75% at our low in May. Now we're probably testing it today as we speak, so we shall see. I think one of the things that has happened is during risk-off periods, we see a rush back into indexes. Even so, a lot of the market's gone passive, but when we move into risk-off, this idea of career risk, business risk surfaces in discussions, and there's a movement back into benchmark stocks. We don't own the big benchmark stocks. Only one of our stocks has made it into the benchmarks, and that's Tesla. And believe it or not, Tesla's held up better than our portfolios, right? So I think there's been a lot of algorithmic trading. I felt it pre-COVID. The variables algorithms focused on cash burn, cash cushion. And yet at the time we were saying, wait a minute, this makes no sense. This is COVID, and we need to solve this problem. Innovation solves problems. And so that was one of the reasons we had that swoosh, right? We were solving problems, global digitalization, figuring out how to sequence the coronavirus and so forth. I think the same thing now. We've had this incredible decline. We have so many more problems now. Supply chain, Russia's invasion of Ukraine. Innovation solves problems, and yet these algorithms and very short-term time horizons. Ours is 5 years. The market in risk-off goes to 1 quarter. Algorithms are dominating the market. It's very interesting. Most people don't know what our companies do, and they don't know the kinds of problems they are solving. But as we've gone through this period, this 75% decline, we've concentrated from 58 names to 33 names, to our highest conviction names. Typically, that's a very good strategy for the turn in the market. We are not an asset allocator. We are focused exclusively on disruptive innovation, transformative innovation, and I think we're fulfilling an unmet need out there. We are doing research and giving it away to help educate people on how our world is going to transform. Well, we won't own Chinese stocks in the flagship fund. We started pulling them out when Jack Ma was banished in November of 2020, after building up Chinese exposure quite significantly, because what excites us most is the convergence between and among technologies. That means that S-curves are going to be beating S-curves, and we're going to see some explosive growth opportunities toward the end of a bear market and during recessions. Our growth is far superior to that of the broad-based indices in terms of revenues and so forth.